Brazil and the UK's FTSE 100 were the best three performing stock indices in 2022 in local currency terms based on those headline indices, and the USA was actually one of the worst. And while it was tough sledding for equity investors, it was an awful lot tougher for bondholders and cryptocurrency traders. Meanwhile, natural gas shot higher, but oil and gold did nothing, and food price increases actually began to ease at the end of the year, with the result that financial markets are trying to end the year buoyed by hopes that inflation is peaking and interest rates are poised to fall in 2023. Now, it's worth thinking about all of what happened in 2022 and why, as those key themes could continue to shape financial markets performance and thus investors' returns from their portfolios in the year ahead and beyond. Five trends in particular looked to make their presence felt. The first is energy and its effect upon inflation. Russia's invasion of Ukraine in February gets a lot of the blame for the spike in inflation suffered in the West in 2022, and in fairness, natural gas prices are up by more than 80% this year using the American Henry Hub benchmark. And in Europe, the Dutch TTF natural gas futures price in euros per megawatt hour is up by more than 100%. Oil, however, is almost unchanged based on Brent crude. At $80 a barrel, it's trading a third below its spring peak of 125, while the European gas price is actually as well trading miles below its panic-driven peaks of the spring. Oil's down because of America's release of a big chunk of its strategic petroleum reserve, OPEC Plus's affirmation in its December meeting it wants a balanced market, and also fears of a global recession in 2023, while the EU gas price is down thanks to increased liquefied natural gas shipments, higher storage levels, and a pretty mild start to winter. Yet, China's reopening post-COVID, America's ultimate need to replenish its SPR, ongoing sanctions against Russia, and relatively limited levels of investment in exploration of production by oil companies could yet influence or even put a floor under the price of black gold in 2023. The second key trend to watch, well, that's how interest rates, I should say, finally moved higher in response to inflation. The direction of travel in terms of monetary policy in 2022 is pretty clear, as central banks responded to the return of inflation and pushed through around 350 separate interest rate increases between them and sanctioned fewer than 20 cuts. And those reductions came mainly from Russia, China, and Turkey, countries with particular economic challenges or political and indeed economic agendas of their own. In addition, quantitative easing became quantitative tightening as further means of tightening the quid policy, although Japan remains a bit of an outlier here, though even it now seems to be moving slowly towards QT rather than QE. Markets are now hoping that a perceived peak in inflation and a late 2022 slowdown in the degree of interest rate increases in America, Australia, Canada, the EU, UK, and others will lead to a monetary policy pause and then pivot in 2023, when the first rate cuts are currently being priced in by bond markets for the fourth quarter, just in time for next Christmas, in fact. The third trend, well, that's the regal process of the mighty dollar. As the US Federal Reserve jacked up the Fed's funds rate from 0.25% in January to 4.5% by December, the greenback initially surged. The trade-weighted DXY or Dixie index flew to its highest mark since 2002, and at the same time the dollar began to exert its gravitational pull on both commodity prices and emerging market equities. Raw material prices tend to trade inversely to the dollar because, with the exception of cocoa, they're priced in the US currency. If the dollar rises, this makes them more expensive for nations whose currency is not the greenback or pegged to it, and can therefore lead to demand destruction. Emerging equity markets tend to trade inversely to the buck because a lot of them have dollar-denominated debt. As the dollar rises, servicing this debt becomes more expensive in local currency terms, and those interest rates payments suck away cash that could otherwise be used for productive domestic investment. Commodity traders and holders of emerging market stocks will have been pleased, therefore, to see the dollar lose around 10% of its value in the final quarter of 2022, as markets priced in that monetary policy pause and pivot from the Fed in 2023. The fourth trend, well, that's the cryptocurrency crumble. As central banks raised interest rates and started to sterilize QE, they withdrew a portion of the cheap liquidity that had had so much to do to boost risk appetite and elevate asset prices across the board, especially in 2020 and 2021. That forced a reappraisal of risk appetite, as money was now costing something. There was an opportunity cost there, especially as cash and bonds began to offer improved returns, at least in nominal pre-inflation sense. And also some of the more, therefore, esoteric areas of this markets came under the cosh. Junk or high-yield bonds took a pasting in fixed income. Emerging markets, initial public offerings, SPACs and meme stocks fell to earth in equities, and cryptocurrencies cracked. Now, cryptos were not helped by a series of setbacks and scandals, including the fall of Luna, the Three Arrows hedge fund's failure, the bankruptcy of broker Voyager, the demise of lender Celsius, and then the collapse of FTX and Alameda, and arrest of their founder and cryptocurrency luminary Sam Bankman-Fried. The ripples could yet linger, as other crypto platforms are suffering outflows or pausing client withdrawals, while questions over the health of Tether refuse to go away, and the US-traded Grayscale Bitcoin Trust traded a huge discount to its reported net asset value. Bitcoin's lost around 2/3 of its value in 2022 and retreated to levels last seen in 2020. Meanwhile, that other perceived haven during times of policy panic, gold, outperformed Bitcoin pretty handily in the year by the virtue of doing basically nothing. Its price is broadly unchanged in 2022, but even gold's ending the year with another attempt to break back above the $1,800 an ounce mark. And the fifth and final major theme of 2022 was the pounding of technology stocks. Loss-making jam tomorrow companies were crushed as risk appetite waned, and even the Marnham sextet of Meta, Amazon, Apple, Netflix, Alphabet, and Microsoft failed to avoid the shakeout as sales and profits growth disappointed, and in one or two cases, cash flow dried up, thanks to weaker ad revenues, galloping cost growth, tighter regulation, and the squeeze on consumers' pockets from inflation. As I sit here, the Nasdaq's down by a third from its late 2021 all-time high, and the Marnham sextet has shed $4 trillion in aggregate market cap between them since their individual peaks, although having said that, their combined price tag is still a beefy $6.8 trillion. For want of a better turn of phrase, growth outperformed value for the thick end of a decade, thanks to the prevailing low growth, low interest rate, low inflation environment. But a change to higher inflation and higher rates has prompted a reappraisal, and if inflation or stagflation even are here to stay, and rates stay higher for longer, then tech could remain out in the cold going forwards. We shall see. Thank you for watching. I hope that you and your families are well and in good spirits, and may 2023 be a happy and prosperous new year for you all.